Welcome back to Accounting 5000. This is Module 10, in which we're going to finish up Chapter 5 by looking at two particular pieces of the chapter, inventories and prepaid expenses. So let's start out by talking about what inventory is. Inventory is the set of stuff that a company has that they're going to resell. Often it's easiest to think about this in terms of a retailer, perhaps a grocery store, where you can look around and see cans of beans and loaves of bread and boxes of soap. They are going to take those items and sell them to a customer. But in order to have those items in their store, they had to go buy them somewhere else and put them in the store. So we have an inventory amount. You may have noticed that some firms go around at the end of the year or at the beginning of January and take what they call inventory. They're going through and counting all the stuff that's in their store. They want to know what they have to resell to customers. That's called their inventory. Inventory is sold to the customer, and it becomes that famous word, cost of goods sold. You may remember back from chapters 2 and 3 when we talked about cost of goods sold being an expense. It's the first thing that's deducted from sales, and it gives you gross profit. Well, what we're going to talk about in this chapter is using our inventory idea to come up with the cost of goods sold. So let's talk a little bit about what happens in the inventory system. Let's say you're a grocery store, you're opening up, you have nothing on your shelves, so you go to a supplier and you purchase all sorts of stuff to put on the shelves. You record that in your book as inventory. As the year goes along, you sell off different things on the shelves and you restock the shelves with more inventory. Then at the end of the year you go in and you count and you see what's left in the store. Everything that's missing or is no longer there you assume has been sold, and those are the items that are going to go into cost of goods sold. Everything that's still there that you can count you consider ending inventory. So to make a very simple example of it, let's say you start out the day with 2 bananas, and you go down to the grocery store and you buy 5 more bananas. That gives you 7 bananas. During the day you munch on some bananas, and when you get home that night you realize you've only got 3 bananas left. Well, if you started out with 2, you bought 5, that gave you 7. If you have 3 left, then you've eaten 4 of the bananas. That's the same concept we're going to use today, looking at cost of goods sold and ending inventory. In order to put a price on the inventory that's sitting there on the shelves, we have to come up with some flow of costs. Now these cost flows don't have to be the same as the actual physical flow of the goods, but often it's easiest to think of it that way in your mind because it makes it easier for you to understand the concepts. So when we're looking at cost flow assumptions for inventory, we have 4 different methods that we use. One is called specific identification. When we're looking at cost flow assumptions using specific identification, we are assuming that we know exactly which item was sold. For example, if you go down to buy a car, you can be assured that the car dealer knows exactly which car you're buying, because not all the cars are the same. Some have different kinds of stereos, some have different kinds of power windows, different colors. They're all different. So the car dealer knows exactly which car he sold you. So he knows exactly what his cost of goods sold is because he knows what he paid for that car from whomever he bought it. That's specific identification. It's typically used only in industries where you have large dollar items and there's usually a small number of turnover. In other words, they don't sell a lot of them at any one time. That's a specific identification method that's used fairly rarely. The 2 that you're going to see used most often are called LIFO and FIFO. LIFO stands for last in, first out. And the easiest way to think about LIFO is if you think about a big barrel. You often see them in the aisles of grocery stores, and they're full of bars of soap, and they've just got bars of soap in them. Well, when they get more soap, they just dump the soap in on top of the old soap. So the first thing the customer's going to buy is the stuff that was last in. The last stuff they poured in will be the first thing that they sell. So the last thing they get in is the first thing they sell. Their ending inventory then will be the stuff at the bottom of the barrel. The oldest soap will be at the bottom of the barrel. That's last in, first out. Now contrast that with first in, first out, often called FIFO. The first thing in is the first thing you're going to sell. And you often see this on the shelves of grocery stores, specifically if you look at milk. They will have the oldest milk in the front. And if you dig down through the milk cartons, you can find some milk that's dated much later. The newest milk is in the back. What the grocery store is trying to get you to do is to buy the oldest milk first. So the first milk they got in is the first milk that they sell, or FIFO. A lot of people in the grocery stores hunt around through the shelves, baby food and canned goods, produce, to find the freshest they can rather than the stuff that's come in the latest, the stuff that should be sold first. So that's a way to think of FIFO, the first cost in or the first cost you want out. Now typically it wouldn't make any difference if price levels stayed the same. If you always bought your soap for the same amount of money or you always bought your milk for the same price, there wouldn't be any difference in between FIFO and LIFO inventory methods. Where we run into a difference is when prices change over time, and typically prices go up. So it's a company's advantage for tax purposes to use LIFO, because under LIFO the oldest costs are expensed. That means you have lower net income, therefore you pay less tax. So most companies will use LIFO for financial reporting purposes because it lowers their tax burden. Some companies can't make a decision as to whether they want LIFO or FIFO, and neither one really is a good alternative for them. So they use our third calculated method, which is called a weighted average method of inventory. What they're doing there is figuring out how much the average cost of a particular piece of inventory is, but instead of just an average, they're weighting the average. If there are more goods at one cost than at another cost, then they give more weight to the goods that have the highest number of goods. So it's a weighted average of inventory costing. Now you can see these four methods demonstrated in your textbook on page 153, continuing on to page 154. They go through and demonstrate for you how to calculate inventory at the end of the year based on different cost flow assumptions, and how to calculate cost of goods sold using those same cost flow assumptions. So if you need some examples, they're there in the book. In just a minute we're going to work a problem using the different cost flow assumptions so that you can see how it works and how it affects net income. The second thing that we need to be concerned with in this chapter are prepaid expenses. Now we've talked about prepaid expenses for several different modules now, but let's talk about them just for a second in detail. Prepaid expenses are those items which you incur ahead of time. You buy your insurance a year at a time. You pay your rent 3 or 4 months at a time. When you do that, you have items on your books that you haven't used up yet, and they are assets for you until you actually consume them. So we call those prepaid expenses. You will find them in areas like prepaid insurance, prepaid rent. Sometimes you may even see them in something like prepaid supplies. But those are the type of accounts that you will find that are prepaid. Remember, they're assets and they will be used up over time, and you will have to make adjusting entries to make sure they have the correct amounts in them so that when you do your financial statements at the end of the period, you're not showing too much in your prepaid accounts. Let's look at some problems that demonstrate these two concepts, prepaid expenses and inventory. And let's use problem 13 first for our prepaid explanation. Problem 13 is in your book. It starts at the bottom of page 172 and it continues over to the top of page 173. In Part A, it says, use the horizontal method or write the journal entry to record the payment of a 1-year insurance premium of $3,000 on March the 1st. Okay, if you're going to prepay something for $3,000, that's an asset. So you're going to increase your asset of prepaid insurance with a debit. Paid means your cash went down, cash is an asset, You reduce an asset with a credit. So your journal entry looks like what you have there at the top of that slide: debit to prepaid insurance and credit to cash. Now in Part B it says to write the adjusting entry you're going to make every month until you've used up your prepaid insurance. Well, if you paid $3,000 for 1 year, take that $3,000 and divide it by 12, because there are 12 months in a year. That means each month you're going to use up $250 worth of insurance. So your adjusting entry will be to move it from the prepaid insurance account. So you reduce prepaid insurance, your asset, by crediting it. You debit your expense, increasing your expense account, insurance expense $250. Then in Part C it says calculate the amount of prepaid insurance that should be reported on the August 31st balance sheet. Well, notice you bought this insurance March the 1st. So you have March, April, May, June, July, and August. That's 6 months worth of insurance. So you take $250 times 6 months, and you should get $1,500. Should still be in your prepaid insurance account. In D, it asks you if the insurance premium had been $6,000 for a 2-year period, how should the prepaid amount on August 31st of the first year be reported on the balance sheet? Well, if it's $6,000 for 2 years, you're going to take the $6,000, divide it by 24. That gives you $250 a month, but there are 18 months still remaining out of your 2 years. You've only used a half a year, so that's 6 months that you've used. So you should have $4,500 still showing in your prepaid insurance account. Finally, in Part E, it says, why are prepaid expenses reflected as an asset instead of being recorded as an expense in which they're paid? Again, we get back to that matching concept that we talked about in Chapter 2. We want to match our revenues and expenses so that they're the same time period. When we generate a revenue, we want the expenses reported at the same time. Okay, let's work an inventory problem. Practice our inventory. Let's look at problem 26 in your textbook and look at the inventory. Problem 26 is on page 179 at the very bottom of the page, and it's continued over to the top of page 180. What you have here is some information for Selco for the fiscal year ending January 31st, 2004. And in that purple box, they show you they sold 800 units. They started out the year with 250 units that they purchased for $4. During the year, they purchased, in chronological order, 300 units, 400 units, and 200 units. And notice that each of those purchases was at a different amount. And in Part A, they ask you to calculate cost of goods sold and ending inventory under each of the cost flow assumptions, LIFO, FIFO, and weighted average. Okay? In order to do that, we have to know how many units are in ending inventory. So what I've done is set up for you on this slide a little calculation formula where you take your beginning inventory in units. Now notice this is in units. You add the number of units that you purchased, and that GAFS tells you the goods that were available for sale. Your beginning inventory plus what you purchased was there to sell, 1,150. Of those 1,150, you sold 800 of them. So all you have left is your ending inventory of 350 units. What you're going to do now is put a price on those 350 units. So under FIFO, the first thing you have is the first thing you're going to sell. You're going to sell 800 units. So you're going to sell the beginning inventory of 250 units, plus your first purchase of 300 units, plus enough units out of that next purchase to give you a total of 800 units that you're selling. You then multiply each of those numbers by the cost that you paid, $4 for the 250, $5 for the 300, $6 for the 250, and you find that you actually sold $4,000 worth of inventory. Your ending inventory then is what's left over. That's that 350 units that's left over. Well, the 350 units is the stuff that you bought most recently. So it's 150 units at $6 plus 200 units at $8 for a total of 2,500 units, $2,500 for those 350 units. One thing I want you to notice on this problem is that your $4,000 cost of goods sold plus your ending inventory of $2,500 total up to $6,500. That will be true in all cases. For example, in the next one where we're doing LIFO, you'll notice that our cost of goods sold is $5,000 and our ending inventory is $1,500. It's still going to total up to $6,500. So no matter which method you use, they will total up to $6,500. We're just splitting that $6,500 up between cost of goods sold and ending inventory. Under LIFO, the last thing we got in is the first thing we sold. So we start by calculating the most recent purchases being sold. So we start at the bottom of the list, the 200 units at $8. We work our way up the list, 400 units at $6, and then enough units out of the next category to give us 800 units. So that would be 250 units at $5. You do your math, multiplying out, and you find you have $5,000 cost of goods sold. Well, your ending inventory under LIFO is your oldest stuff, your beginning inventory plus whatever else is left over. So you have 250 units of your beginning inventory at $4 left, plus 100 units of your first purchase at $5 left, for a total of $1,500 worth of ending inventory. In your weighted average problem, what you do here is take every item of purchase. For example, your 250 at $4, your 300 at $5, your 400 at $6, your 200 at $8, and you multiply them out. You get your 1,000, 1,500, 2,400, and 1,600. Total those up. You get $6,500. That's the cost of the 1,150 units you had available for sale. So what you want to do is find an average cost of those 1,150 units. So you take your $6,500, you divide it by 1,150 units, and you get an average cost of $5.65. So since you had 800 units in cost of goods sold, you take your 800 units times $5.65, your cost of goods sold is $45.20. Your ending inventory consists of 350 units at $5.65, or $19.80. And if you add the $45.20 and the $19.80, you will get $6,500, just like we did in the other two methods. In the second part of this problem, they ask you, assume that net income using the weighted average cost flow assumption is $14,500. Calculate net income under FIFO and LIFO. Well, what you'll see is that FIFO and LIFO are slightly above and below your weighted average cost. So if you look at your cost of goods sold under FIFO, it was $4,000. Your cost of goods sold under weighted average was $45.20. So that's a $520 difference that you need to add to net income. So net income under FIFO will be $520 more, or $15,200. Under LIFO, the reverse is true. The weighted average cost of goods sold was $45.20, but the LIFO cost of goods sold was $5,000, so it was more, $480 more, which you need to subtract from your weighted average net income in order to get a LIFO net income of $14,020. Okay, let's do one more inventory problem. Let's look at problem 29 in the middle of page 181. It says, if the beginning balance of the inventory account and the cost of items purchased or made during the period are correct, but an error resulted in overstating the firm's ending inventory balance by $5,000, how would the firm's cost of goods sold be affected? Explain your answering by drawing T accounts and entering the accounts. You can do that if you want to, but what I wanted to demonstrate to you there was that inventory is going to have to be reduced by $5,000. That means cost of goods sold is going to go up by $5,000. If cost of goods sold is too low, then net income is too high. So just think about the relationship between net income and cost of goods sold. If cost of goods sold is too low, net income is too high. If cost of goods sold is too high, net income is too low. So those two are very much related. The better question is part B. If management wanted to understate profits, in other words, they wanted to show their profits less than they actually were, would their ending inventory be understated or overstated? In this case, in part B, if ending inventory were understated, cost of goods sold would be overstated and net income would be understated. So the answer to that is ending inventory would be understated. They would make a lower number for ending inventory, thereby showing their net income to be less than it should be. The final problem that we have in this chapter is problem 13. Is that right? No. Problem 12. Let's look through your book. Problem 12 is on page 172. And this is where I told you not to forget ROI. This talks about the influence that different inventory methods have on ROI. NATCO Inc. uses the FIFO inventory cost flow assumption. In a year of rising costs and prices, the firm reported net income of $120 and average assets of $600. If they had used LIFO in the same year, cost of goods sold would have been $20 more than under FIFO, and average assets would have been $20 less than under FIFO. They ask you there to compute the ROI under both assumptions. So what we need to do is go back and compute ROI. Now think about how we compute ROI. We take net income and divide it by average total assets. So under the first example, our net income is $120 and our average total assets are $600. So if we take $120 and divide it by $600, we will get a 20% ROI. In the second instance, it says that our income will go, cost of goods sold would have been $20 more. Well, if cost of goods sold is $20 more, then we'll need to add $20 to our 120. And it says that our average assets would have been 20 less, so we subtract 20 from our 600. So we get 140 divided by 580, which gives us 17.2%. Then in part B it says, suppose that 2 years later costs and prices were falling. Under FIFO, net income and average assets were $130 and $650 respectively. If LIFO had been used, the inventory values would have been 30 less and it would have been 10 less under FIFO. So what happens here? Well, in the second year, $130 divided by $650 will give you a FIFO ROI of 20%. If we add the $10 for LIFO adjustment to our net income and subtract out the $30 adjustment from our average total assets, we will get a LIFO ROI of 22.6. So I think you can see from that the type of inventory cost flow assumption that you use can affect your ROI by changing both your net income value and your average total asset value. So lots of companies will weigh this ROI calculation into their decision about which cost flow assumption to use. But what you'll find, I think, is that if you look through firms' annual reports, you will find that most firms will be using LIFO in their annual reports, simply because LIFO, in times of rising prices, reduces the firm's tax liability. And you have to pay taxes with cash, so it helps their cash flow situation to pay a smaller amount rather than use a different LIFO or FIFO assumption to increase their tax liability. So most firms use LIFO. With this module, you have completed the first 10 modules of this course. You are ready to take your first exam. Your first exam will be over the first 5 chapters of this textbook. It will consist of 25 multiple choice questions and anywhere from 2 to 3 to 4 problems. So you'll need to contact me, make arrangements to take your first test.